Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for 𝗧𝗴𝗀. Today is Tuesday. It is the 14th of September. We're halfway done through September. I remember celebrating. I remember eating my Labor Day steak. Where has the summer gone? I protest. Anyways, let's start off with the morning. The market's going to open up in a little less than 2 hours. Kind of flat, not really anything going on. As you can see here, the Dow futures, don't look at the far out month. This is some craziness. But as you can see here, the markets are pretty random pre-opening bell. The big report today is the CPI, which is the inflationary data. Investors and traders are looking for a year-over-year increase of about 5% and a month-over-month increase of about 0.5%, 0.4%. That's the expectation. The biggest benefactor is going to be the bond market, not the stock market, because inflationary pressure is going to impact bonds, because that's what the Fed uses to decide whether to keep pumping money into the economy or not. Expect the bond market to remain choppy as it's been within this channel. And finally, as we end September, get into October, I think we're going to break down, because I think the market is going to start anticipating the Fed raising rates. In terms of the global news, let's talk about the global economy, kind of give you an overview of what's expected today, and then we'll talk about the technicals. Inflation data, CPI. This whole week is about inflationary data, actually. Headline stands at 5% as consumer activity revives. And that's exactly what I was talking about right here, about 5% and about 0.5%. So if year over year is higher than 5%, the Fed may have to taper. So keep your eye on the bond market, because if the Fed has to taper, right, bonds go down, interest rates go up. If Fed doesn't taper, if inflation's low, then the bonds would go up and interest rates would kind of stay where they're at. Keep your eye on that. And remember, watch this video a few times to understand the dynamics of what I'm talking about. The spike, the price spike, and we're talking about inflationary price spike, has prompted fears that the Fed might feel pressure to roll back easy credit and other stimulus boost share prices. But Fed officials have indicated they believe the surge is temporary. How temporary is it? You guys have been saying it's temporary now for 6 months. Is beer prices temporary? Paying $10 for a six-pack of beer? I hope that's temporary. And they will keep interest rates low until a recovery is established. And interest rates are low, and I think they're going to go higher. Trading on Wall Street is choppy as investors try to figure out whether or how the economy will develop. And the big report is going to be U.S. retail sales, and that's going to be on Thursday. And that's going to be the big report this week. Not jobless claims, but retail sales. Retail sales make up about 2/3 of the economy. So again, industrial production, big report this week. Retail sales and CPI. This week is all about inflation, bottlenecks, supply chain issues, and inflation. That's where industrial production, CPI, and retail sales comes in. And I'm going to tell you guys something. Holidays are right around the corner, and if we continue seeing these supply chain issue, these chip shortage issues, consumer stocks will rally, because there's supply demand, not enough. So keep your eye on that. That's one of the reasons actually why I'm keeping an eye on consumer stocks right now, and I'm going to keep an eye on them till the holidays, because if we break out on the consumer stocks, we're going to have a major issue. If they keep talking about a major supply chain issue, if kids can't get their toys and if people have to pay up, it's going to be a madhouse for consumer discretionary this holiday season. Or it could work the other way around. So keep your eye on that. Now, this is very important. Put to call ratio. I want to show you guys something. We have the highest put to call ratio since we've had in, let's see here. Wow, 520. 520. So volatility should start increasing, which we'll look at in a second, but put the call ratio is at 117, which means the market is stretched out to the downside. Now, if you look at the Nasdaq right now, we've had a few down days, and it looks like we're going to start coming back up. And if you look at the RSP, which is the equal weighted SPY, you will see that we are quite choppy, and we're right at the 50-day moving average. And again, if you look at momentum levels, and I want to show you momentum levels on the SPY, you will see that we're literally 53% are at the 50-day moving average. And finally, we're starting to see a sell-off on the number of stocks trading below the 200-day moving average, which I haven't talked about in quite some time, but let me show you this. So momentum levels are cooling off, as you could see here. Now, they've been here for a while. Anytime they come up here, and we were at the highest level several months back, around April, and I told you guys we were going to come off. Now, they can continue coming off slowly, or they can come off hard. It looks like they're coming off real slow, which is really good for the market. And if it continues this way, we can really go down nice and easy without having a major correction. So it looks like it's happening right now, but I think the second shoe is going to drop, and I think it's going to take us to the 50-day line, which means the market is going to get choppier before it clears up. But the put-to-call ratio right now is giving us a major alert. This is a major, major oversold signal. So if you're a SPY trader, or if you're an S&P, or if you're a regular market trader, you may consider starting to look for long positions, because I don't think we're going to break this level. The put-to-call ratio is too high right now for us to go lower, and markets are too choppy. So I don't think we're going to see much follow-through. I think we're going to continue seeing the choppiness, which means we're getting close to the downside, and that means it's time to go long. Now let's look at volatility and see if it's picking up as I predicted that it would. Yes, it is. And if you look at volatility here, you will see that volatility is coming up. Now, will it go a little higher? I don't think so. I think it's going to continue going down. I think it peaked out around here, maybe stay around these levels. I don't think we're ready to go down yet. I don't think, based on what I'm seeing, and I thought large institutional traders would come in, and they probably already have, but the choppiness and the sideways trading action that we're seeing on the stock market, if I could only type, is telling me we're still very, very, very choppy, and we're going to kind of rock and roll around these areas for quite some time. So this is not a market you want to buy breakdowns or breakouts. You want to buy pullbacks. Breakdown pullbacks, breakout pullbacks, but pullbacks, not pure momentum plays. That's why yesterday when I showed you pullbacks, I showed you pullbacks to the downside. In other words, market goes down, breaks down to the downside, pulls back a little higher, and gives you an opportunity to sell short. Now, in terms of each individual sector, I think we can see a little upside in the financials. I think energy is going to remain choppy unless we break above the 50 level on the XLE. Consumer staples is going to remain choppy, not really go anywhere. I think utilities are going to remain choppy and not really go anywhere. What's going on here? Is my internet not working? Let's see. Let's see. Stock Fetcher. What's going on? No, looks like things are not working as well. All right, let's move on here. So utilities are I can't seem to get a price on these. That's the weirdest thing. Huh, strange. Anyhow, I've got two stocks that I need you to look at. Evolent Health, pulling back a little bit and already springing back up. It's looking really good. EVH, ticker symbol. And next one is BUG, B-U-G. It's Global CyberX Security ETF. Pulling back, I think we're going to go higher. EVH and BUG. Now, looks like it's finally working. Look at that. Looks like it's working. Let's go back through the analysis. There we go. Okay, perfectly. So financials a little higher, maybe test the highs. I like financials right now. Energy, we need to break through 50. Once we break through 50 and once this pandemic, this Delta variant is cooled off, energies are going to rise again. Nothing for consumer staples. Utilities maybe a little to the downside, especially if discretionary stocks continue rising. Industrial, not much one way or the other. Healthcare, I'm not that happy about, but I think this is the end of the pullback, and I think we're going to be coming back up. Tech, remain choppy. Not really much upside. Choppiness in basic materials. Communication sector, I think, bottomed out, and I think is going to start coming back up. I think real estate bottomed out, and it's going to start coming back up. And I think consumer discretionary is trying hard to break past that 185 area, as I showed you right here. But it's not going to do it just yet. It may take a little while because the market's pulling back. The biggest takeaway is the put-to-call ratio, which is telling us that there's too many put buyers right now in comparison to call buyers, and that usually snaps back like a rubber band, like boom, and reverts. You like those sound effects? Boom. I got to have a little fun here too. And again, two stocks, EVH, like Eddie Van Halen, right? May he rest in peace. And BUG. I like this. I like this for a little pullback. I think this is done, maybe another day. And I like EVH. I think it pulled back, and I think it's going to come up. Now, I'm not just going to let you go. I've got something important for you, something you need to pay real close attention to. Just because the market is unpredictable mess right now, it doesn't mean investors' financial situation also has to be. And that's why. That's why Joy of the Trade, head trader, 𝗧𝗴𝗀, he's sharing a strategy that's working in all market conditions. Choppy conditions like this, bearish conditions, bullish conditions, it just works. He relies on a little-known anomaly, and there's never, ever been a better time to implement Jeff's strategy. With interest rates set to increase, sometimes this year, and I think it's going to be this year, but it could be next, we will continue to see choppiness, the sideways markets. It's not pretty right now. Markets are getting more complicated to trade. And when markets gets more choppy, you need a system, a systematic way to trade these ebbs and flows. Now, Jeff's strategy allows him to use money links to hedge against surprise pullbacks and even make money off of them. Linked trades. I love it. I love it. It works, and it works in all market conditions. Are you ready to see how money links work and how they can be used in volatile markets? Click on the link below and learn all about it. You got to check out these money links. I love them. These pair trades are awesome. They work in every type of market condition, even the one we're in right now where we're just choppy. So you got to be very defensive. You got to be very careful. You got to be very selective, and you got to find out about these money links. Do it now. Click on the link below and learn all about them. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when I post my next video just for you. And have a great day. And send me some feedback if you're getting some love out of these videos. I need to know. Send me an email, support@marketgeeks.com. Bye. Have a great day.